Let's start out by talking about modifications. A modification is when you ask the lender to voluntarily change the terms of the loan, maybe lower the interest rate or reduce the payments to make the home more affordable. This is hard to get into on the video because there are so many different variables. Most of the time you need to qualify for a modification, which means you have to demonstrate that you have enough income that you need the loan to be modified, but you don't have so much income that you can afford to make your payments at their current level. So you kind of have to fit into the gray area in order to qualify, and that involves calculating your debt-to-income ratio and other things like that. Also, currently there are some programs out there, but the programs are constantly changing. This field of law, more than any other, changes on a weekly, monthly basis. So it's really important, if this is a remedy that you want to pursue, that you contact our office, because at the time of this taping, I don't know if the same programs are going to be available out there if you're viewing this 3-4 months after this taping. So for that reason, we really need to discuss this on a one-on-one basis. But I just want to say this. Most people that see me for a modification are a little bit unrealistic. I can and do, for many of my clients, get modifications, but it's not so easy to get your lender to reduce the principal down to what the property is currently worth, and that's what most of my clients really need in order to be able to afford the home. So if you're looking for this, not that it isn't done occasionally, but it's not that easy to do that. So I just want you to be realistic about what a modification can and can't accomplish. Many times for me to get principal reductions, we either have to deal with this in the foreclosure defense setting, where we can put some pressure on the bank, maybe by making it difficult for them to foreclose, to modify and give you a principal reduction. The other time is there are certain lenders that are compelled through settlements with the Attorney General of the state of Florida to reduce principal. For example, if you've dealt with one particular lender and you have a pay option arm on your primary residence, they're actually compelled by their settlement with the Attorney General to reduce your principal to the point that you can afford it if you qualify. So because there are so many variables, we really have to deal on a one-on-one basis with this, but modifications can and do happen. Before we get into the other remedies, we need to talk about something called a deficiency judgment. Deficiency judgment is really the elephant in the room, because that's what all the other remedies are designed to avoid. So a deficiency judgment is basically this. Let's give an example. And of course, I'm just making these numbers up as a hypothetical, but let's assume somebody owes $300,000 on a mortgage. For one reason or another, either they can't afford to make the payments, they don't want to make the payments, they stop making the payments. Now, assuming this person doesn't do anything, they don't negotiate with the bank, they just wait till this property forecloses. Eventually, because it's a process that takes time, eventually a foreclosure will be filed, and eventually that property will be sold at the courthouse at something called a foreclosure sale. Now, when the lender gets the property back, and I'm assuming the lender is going to get the property back, because if it's like most foreclosure cases, nobody's going to pay more than the lender is owed, which means the lender will become the new owner of the property. Let's say when the lender becomes the new owner of the property, because the real estate market has gone down, that property is now only worth $200,000. So you owe $300,000, but the property is only worth $200,000 at the time of the foreclosure, so your lender has a loss of $100,000, and that loss is referred to as a deficiency. So a deficiency is the difference between what you owe and what the property was worth at the time the property transferred back to the lender. Now, the lender has two basic options. Option number one, they can go back into court and pursue a judgment for that $100,000. And then they can pursue collection off of your non-exempt assets. So what that means is, not only could you lose the property, but the lender could sue you for the difference and take away other assets you have. The other thing that a lender could do is they could write this off as a bad debt. And that's what we want to try to accomplish. So, for example, let's assume, and again, I'm just going to make this up, let's assume that your lender makes $1 million profit. Well, they have to pay taxes on that $1 million. Now, if they were to write off that $100,000 loss that they had on your property as a bad debt, now they only have a $900,000 profit. So now they'll pay taxes on $900,000 instead of $1 million, and that's going to be a tax savings to them. So whether or not your lender pursues collection of a deficiency judgment or writes it off as a bad debt is going to depend on a number of factors. One of the more important factors is going to be, are you collectible? If the lender believes that you have lots of assets, lots of money in the bank, big income, they may decide to pursue collection. On the other hand, if they think that you don't have much in the way of assets and that you're really going to be uncollectible or difficult to collect from, then it would probably be in their best interest to avoid additional attorney's fees and costs of pursuing a collection and instead write that off as a bad debt. Let's talk about the remedy of a short sale. A short sale is basically when you sell your property, but you sell it for less than you owe the lender. So you negotiate, you enter into a negotiation with your lender to accept that sale price and waive or write off the balance. Now, because you're asking the lender to do something voluntarily that they're not legally obligated to do, the lenders are going to put conditions upon that. Before they agree to accept a short payment and accept your sales price and write off the balance, they're usually going to require that you provide them certain information. Why? Because lenders view short sales are for individuals that, due to a hardship, don't have the financial ability to continue making their mortgage payments. So in almost all cases, the lender is going to ask for certain information from you. One, they're going to want a hardship letter explaining why you're not able to make the payments. Second, they're going to want a financial statement. Third, they're going to want bank statements, and they may want a tax return or income statements. So banks, as I said, view short sales are for people that don't have the ability to pay. So short sales can be a very good remedy if you can truthfully fill out that information. Why is that a good remedy? Because you, number one, avoid a foreclosure on your credit history. A foreclosure doesn't hit your credit until there's been a judicial sale. So if you're able to prevent that judicial sale from taking place by successfully negotiating a short sale, then you can avoid a foreclosure on your credit history. Now, your credit will still be affected, but it will usually be affected by late payments rather than a foreclosure. And while late payments can damage your credit, in the short run, it usually is not going to affect your credit for nearly as long as a foreclosure would. The second thing you gain is in the short sale negotiating process, we ask the lender to voluntarily waive their right to pursue a deficiency judgment. Now, why would they do that? Because if you find them a buyer and they don't have to foreclose and they can sell that property immediately, they have financial incentive to do so, because now they don't have to pay an attorney, now they don't have to wait the months and months that a foreclosure takes. So we can oftentimes negotiate where the lender will write this off as a bad debt and agree not to pursue a deficiency judgment. Now, let's talk about some negatives of a short sale, because a short sale is not for everyone. A short sale is the best available remedy, I believe, for a person that wants to avoid a deficiency judgment, wants to avoid a foreclosure on their credit history, that can truthfully fill out the financial information that the lender asks for. If you cannot truthfully fill that out, then you're giving the lender information that shows that you are collectible. If you show too much assets on your financial statement or too much money in the bank, then the lender may not accept your short sale, they may not approve it, and now you've just handed through your financial statement a roadmap to the lender of your assets. So now if a lender had a choice to write it off as a bad debt or to pursue collection of a deficiency judgment, you've now made that decision easier for them to pursue a deficiency judgment, and you told them exactly where to go to get it. So if you cannot truthfully fill out that financial statement, you should not do a short sale unless you come see me first. Many times we're able to do some asset planning in anticipation that you're going to have to fill out this financial statement so that you can truthfully answer the financial statement without having to disclose everything. Now, how do you do that? For example, let's say the lender asks for your bank account statements, or do you own any other properties? Well, let's say hypothetically that your money was in a limited liability company or your properties were in a trust. The truthful answer to that then is you don't own any other properties. The trust owns those properties. What you own is a beneficial interest in a trust, but they didn't ask that question. And you're under no legal obligation to answer questions that they don't ask. Now, I just use that as an example, so don't run out and do that without talking to me first. Another potential drawback of a short sale for some people is that if you're successful on your short sale, you're going to have to give up possession of the property to the new buyer. So if, for example, you don't care about a foreclosure on your credit history, or you don't care about a deficiency judgment because you don't have anything, then you may want to wait till the lender forecloses, because that will enable you to stay in your property for a much longer period of time if that's your goal. And listen, with this economy, I know that some of you are in dire straits and really need to stay in the property for as long as you can before it forecloses. And if that's the case, that's okay. We can help you with that as well. What it really comes down to for most people is, what do they value more? Being able to stay in that property for as long as possible, or avoiding a deficiency and avoiding a foreclosure on their credit? If your goal is to avoid a deficiency or foreclosure on your credit, short sale could be the remedy for you. If that's not your main concern, then you should probably go to one of the other remedies like foreclosure defense, which I'll be discussing later. Now let's talk about a deed in lieu of foreclosure. In lieu of is just another word for saying instead of. So what you're doing is you're giving the lender the deed to the property back instead of having them foreclose. Now, why would the lender accept the deed back instead of foreclosing? Well, a foreclosure is a time-consuming and expensive process for the lender. The lender has to hire an attorney, which means attorney's fees. There's costs associated with filing a foreclosure. And if they file a foreclosure, usually the person has stopped making the tax payments and the insurance payments, so they're now paying those as well. And they're having to pay the upkeep and the maintenance of the property. So if you can voluntarily offer the deed back to the lender in exchange for them, let's say, not pursuing a deficiency judgment, you can accomplish two things. One, you know they're not going to pursue you for collection, and two, again, you can avoid a foreclosure on your credit history because the judicial sale is not taking place if you voluntarily give the property back to the lender. So the lender has some financial incentive in many cases for accepting the deed back. And especially if you're not collectible, or the lender believes you're not collectible, then they're really not going to be able to collect on a deficiency judgment anyways. So they might as well take the deed back. Now, it sounds easier than it really is. Why? Because most lenders would much prefer you sell the property than take the deed back. It's for that reason that in my experience, most of the time, the lender is going to require you to at least make a good faith attempt to sell the property before they'll agree to take the deed back and waive the deficiency. So you're usually going to have to list the property, make an attempt to sell it, show the lender the listing history and the listing agreement before you're eligible for a deed in lieu of foreclosure. Now, there's a difference between a deed in lieu of foreclosure and just signing the deed back to the lender. A deed in lieu of foreclosure is typically you're getting something in return. You're getting an agreement up front for the lender, where they agree in writing not to pursue you for a deficiency judgment. If you just voluntarily sign the deed over to the bank, they may not accept it, and they may just continue with the foreclosure because they have the right to foreclose and pursue you for a deficiency judgment. So if you're not getting that agreement up front and the lender accepts your deed, they can still pursue you for a deficiency judgment. So that would defeat the purpose, or that would get rid of some of the leverage you had to negotiate. So you always want to use the leverage you have of costing the bank time and money for closing, and use that in exchange to negotiate some concessions, namely having them agree to write it off as a bad debt and not pursue a deficiency judgment. Let's now talk about bankruptcy as a remedy for people that are potentially facing foreclosure or can't afford their mortgage payments. Now, I'm not a bankruptcy attorney per se, but I do know enough about bankruptcy to speak of it in general terms. Now, in bankruptcy, in my experience, it's usually not the best remedy for most of my clients, and I'm going to explain why in a moment. There's basically two types of bankruptcy for an individual. One is referred to as Chapter 7. A Chapter 7 is referred to as the liquidation chapter. So number one, you have to be able to qualify for a bankruptcy, and to qualify for a Chapter 7, you may have to have an income below a certain level. Now, in a Chapter 7 bankruptcy, you're basically, well, best thing to do is give a hypothetical. Let's say someone has $200,000 in debt, and they have $10,000 in non-exempt assets to their name. Well, if they file bankruptcy, you don't get a free ride. You have to give up the assets you have. Bankruptcy was designed to give you a fresh start, so that if you now make money in the future, you won't have to worry about a creditor taking it away. So if you have $10,000 in assets to your name, the bankruptcy trustee takes that $10,000, they liquidate it, and in this hypothetical that I'm giving, your creditors, who are $200,000 worth, would be paid 5 cents on the dollar, and then you wouldn't owe anybody anything, and you would be discharged, and you'd have a fresh start. Let's take this same example now and say someone has $100,000 in assets. Well, now they're not just giving up $10,000, they have to give up $100,000 in assets. Their creditors are now paid 50 cents on the dollar, and what I find is that you could have probably negotiated a better deal, a much